The role of risk assessment in investment strategies. Risk assessment is a critical component of successful investment strategies, serving as the bedrock for informed decision-making. The fundamental difference between investing and gambling hinges on the ability to understand, evaluate, and manage risk. In investing, risk assessment involves analyzing potential investments to determine their risk-return profiles and aligning them with an investor's objectives and risk tolerance. This process necessitates a comprehensive evaluation of various factors such as market conditions, economic indicators, company performance, industry trends, and geopolitical events. By conducting thorough risk assessments, investors can identify potential threats and opportunities, allowing them to make strategic choices that align with their financial goals. Moreover, risk assessment involves the use of quantitative tools and models to measure risk levels. Techniques such as value at risk, VAR, scenario analysis, and stress testing are employed to gauge potential losses under different circumstances. By employing these methodologies, investors can construct portfolios that are diversified and resilient, minimizing exposure to any single asset class or sector. Continuous monitoring and reassessment of investment risks are also essential, as market dynamics are constantly evolving. Through diligent risk assessment and management, investors can avoid blind speculation and ensure their strategies are grounded in a rational analysis, positioning themselves for sustainable and long-term success without succumbing to the unpredictability akin to gambling. Speculation. Bridging the gap between investing and gambling. Speculation occupies a unique space between investing and gambling, often blurring the lines that define both activities. At its core, speculation involves taking calculated risks in the hope of generating returns. But unlike traditional investing, it emphasizes short-term opportunities and market inefficiencies. While investors typically rely on fundamental analysis, focusing on long-term growth, speculators seek to profit from price fluctuations, market sentiment, or news-driven events. This approach requires an acute awareness of market dynamics, the ability to quickly process information, and an inherent understanding of the factors that can sway asset prices. Similarly, gambling involves risk-taking with an uncertain outcome, but it is largely dependent on luck rather than skill or analysis. Speculators bridge the gap by employing a combination of strategies used in both investing and gambling, such as using leverage to amplify potential returns, which introduces higher risk akin to placing a bet in gambling. However, unlike pure gambling, effective speculation relies on disciplined strategies, market acumen, and the ability to anticipate movements. Speculators often accept that losses are part of the process, but their focus is on finding edges and patterns that can lead to success over time. Thus, while speculation shares traits with both investing and gambling, it requires a unique skill set that balances calculated risk-taking with informed decision-making. Day trading. Investment skill or mere gambling? Day trading has long been a subject of debate, often straddling the fine line between skill-based investment and gambling. At its core, day trading involves buying and selling financial instruments within the same trading day, aiming to capitalize on short-term fluctuations in the market. This rapid-fire approach can yield substantial profits but also comes with significant risks. Proponents of day trading argue that it is a skill-based endeavor. Successful day traders often spend years honing their expertise, learning to read market signals, analyze price charts, and develop strategies to manage risk. They stay informed about economic news and market trends, using this knowledge to make informed decisions. Sophisticated tools and algorithms further assist them in executing trades swiftly, providing a tactical advantage in volatile markets. From this perspective, day trading requires a substantial commitment to education and practice, akin to mastering a craft. Opponents, however, liken day trading to gambling, as it often involves unpredictable, high-stakes betting on market movements. Critics point out that even the most experienced traders can be undone by unforeseen events or sudden shifts in market sentiment, leading to substantial financial losses. Unlike investing, which typically involves a long-term strategy and fundamentals-based decision-making, day trading frequently depends on quick, speculative decisions that can resemble bets rather than informed strategies. Ultimately, whether day trading is considered an investment skill or mere gambling is contingent upon the individual's approach, discipline, and understanding of the markets, as well as their ability to manage the inherent risks involved. Key differences. Long-term growth versus immediate rewards. Investing and gambling are often confused due to their association with financial risk and potential reward, yet they fundamentally differ in terms of time horizons and outcomes. At the heart of this distinction is the concept of long-term growth versus immediate rewards. Investing is driven by a strategic approach that focuses on long-term growth and wealth accumulation over time. Investors typically analyze market trends, economic indicators, and financial performance to make informed decisions, aiming to build a diversified portfolio that appreciates in value over years or even decades. This approach allows investors to weather market volatility and benefit from compounded returns, making patience and forward-thinking crucial attributes for success. In contrast, gambling is characterized by its emphasis on immediate rewards, often seeking fast financial gains through chance rather than strategic foresight. The outcomes in gambling are typically binary and immediate, with little or no room for measured evaluation or adjustment. This creates a high-risk environment where most participants have limited control over the outcome. While successful gamblers can experience significant short-term wins, the transient nature often leads to greater losses in the long run. Ultimately, while investing is about building a sustainable financial future through informed decisions, gambling offers a fleeting, high-stakes thrill with outcomes heavily reliant on luck. The psychological aspects of betting and investing. The psychological aspects of betting and investing reveal both overlapping and distinct emotional experiences that drive individuals to engage in these activities. At the core, both betting and investing tap into the human propensity for risk-taking and the pursuit of reward, sparking feelings of excitement and anticipation. Betting often involves the allure of quick gratification and high stakes, which can lead to emotional highs when winning, but profound disappointment and frustration when losing. This emotional rollercoaster can trigger compulsive behavior as individuals chase losses or attempt to replicate past successes, operating under the influence of cognitive biases like the gambler's fallacy, where they anticipate a different outcome based on previous results. Investing, on the other hand, ideally involves a more calculated approach, though it is not immune to psychological pitfalls. Investors may experience anxiety and stress as they navigate market volatility, influenced by biases such as overconfidence or herd mentality. The long-term nature of investing demands patience and discipline, attributes that can counteract impulsive decisions driven by fear or greed. However, the emotional satisfaction derived from successful investments can reinforce positive strategies leading to sustainable financial growth. Understanding the psychological motivations and challenges inherent in both activities is essential for distinguishing informed decision-making in investing from the often impulsive nature of gambling, leading to better financial outcomes and emotional well-being. Regulatory frameworks. How investment and gambling are governed. Investment and gambling are governed by distinct regulatory frameworks that reflect their different natures and societal impacts. Investment activities are primarily regulated to ensure market integrity, protect investors, and maintain financial stability. In the United States, agencies such as the Securities and Exchange Commission, SEC, and the Financial Industry Regulatory Authority, FINRA, oversee securities markets, requiring firms to adhere to stringent reporting standards and ethical practices. These entities are tasked with preventing fraud and ensuring that investors have access to accurate information, facilitating informed decision-making. Other countries have similar institutions that enforce comprehensive regulations designed to support transparency and reduce systemic risk. In contrast, gambling is regulated to protect consumers, prevent crime, and ensure fairness in the industry. Its oversight falls under various state and national agencies, depending on jurisdiction, often focusing on licensing, operations, and the prevention of illegal gambling activities. Regulatory bodies stipulate age restrictions, advertising standards, and sometimes even impose limits on bets and payouts to safeguard societal well-being. They aim to mitigate the potential negative effects of gambling, such as addiction and financial ruin, by implementing measures that emphasize responsibility and control. While investment regulation emphasizes information transparency and market efficiency to foster economic growth, gambling regulation focuses primarily on consumer protection and ethical conduct to curb social harm. Tools and techniques for effective risk management in investments. Effective risk management is crucial in distinguishing investing from gambling, as it allows investors to make informed decisions that align with their financial goals and risk tolerance. A key tool for managing risk is diversification, which involves spreading investments across various asset classes, industries, and geographies. This reduces the impact of a poor performance in any single investment. Asset allocation is closely related and involves determining the optimal distribution of investments based on an individual's risk profile and investment horizon. Regular portfolio rebalancing ensures that the chosen asset allocation remains intact despite market fluctuations. Another important technique is conducting thorough research and due diligence before committing capital. This entails analyzing financial statements, understanding market conditions, and evaluating the competitive landscape. Investors should also consider employing a risk-reward analysis to assess the potential return of an investment relative to the risk involved. Stop-loss orders are a practical tool that can automatically sell an investment when it reaches a predetermined price, thus preventing excessive losses. Additionally, investors should continuously monitor their investments and stay informed about economic developments. This can involve utilizing technology-driven solutions and data analytics to gain insights into market trends. Finally, maintaining a long-term perspective is vital, as it allows investors to ride out short-term volatility and maintain focus on achieving their overarching financial objectives. The impact of technology on gambling and day trading behaviors. The advent of technology has substantially transformed both gambling and day trading behaviors, blurring the lines between entertainment and investment. With the rise of digital platforms, access to these activities has become instantaneous and ubiquitous, leading to increased participation and, in some cases, dependency. In gambling, online casinos and sports betting apps have made wagering accessible at any time. This ease of access is coupled with algorithms designed to maximize engagement, often leading users into a cycle of repetitive betting through personalized incentives. The gamification of these platforms, with interactive graphics and real-time feedback, enhances the thrill but can also obscure the potential for loss. In the realm of day trading, technology has similarly democratized access to financial markets. Mobile trading apps provide features like zero-commission trades, fractional shares, and real-time market data, appealing particularly to a younger, tech-savvy audience. Algorithms and automated trading strategies promise high-frequency trading capabilities that were once the domain of institutional investors. However, the same technology can encourage impulsive behaviors. Fueled by social media narratives and online communities, traders may be swayed by fleeting trends rather than solid market fundamentals. The smartphone's convenience allows for immediate execution of trades, which can often lead to decisions driven more by emotion than strategy. Ultimately, technology's impact on gambling and day trading has redefined these activities, making it crucial for individuals to recognize the psychological and financial risks that come with this unprecedented access and immediacy. Building a balanced portfolio. Tips to avoid the gambling trap. Building a balanced portfolio is essential in distinguishing investing from gambling. The goal is to create a collection of assets that aligns with your financial goals and risk tolerance, reducing the temptation to engage in speculative activities that resemble gambling. Diversification is a key principle in crafting a balanced portfolio. By spreading investments across different asset classes, such as stocks, bonds, and real estate, you mitigate the risk that comes with putting all your eggs in one basket. This approach ensures that a downturn in one sector doesn't drastically impact your entire investment. Another crucial element is understanding your risk tolerance and aligning it with your investment choices. Being too aggressive or overly conservative can skew your portfolio in a way that feels more like betting rather than strategically investing. It's important to regularly review and adjust your portfolio according to market conditions and personal financial changes, which helps maintain balance and focus. Committing to a long-term financial plan also aids in avoiding the gambling trap. This involves setting clear financial goals and resisting the temptation for short-term gains, which often appeal to a gambler's mindset. Educating yourself about market trends and understanding the fundamentals of your investments can further guide timely and informed decision-making.